All right, and it looks like we're live. Coming up next on the Short Vol Show Live, we have, let's take a look at the term structure, the market, some news in Aurora Cannabis, and other stocks. Thanks for watching, and I believe we are live right now.
I mean, I just keep thinking about you. I mean, I want to move on, but I can't move on.
All right, so welcome to the show. It looks like I pressed the start streaming button and didn't even realize it. Very excited this morning for the move yesterday in Aurora Cannabis. I've kind of been switching between MJ stocks, trying to find which one I want to cheer for after Afria kind of didn't work out for me. That all that short information and it getting tanked a couple months ago, but now it looks like Afria has kind of turned around again. But most of the news for me is Aurora Cannabis right now. Let's take a look at that one. And right next to me here is the stock. And really made a move. Pre-open here was up to 855, but you can see yesterday afternoon, it's kind of like right next to my head here. Let me just move over a little bit. And you can see yesterday afternoon, and throughout the day, actually yesterday, making a big move up, giving it back a little bit, and then more up today. So something's going on with that. There's not a big news story. They got some sort of approval, but I think there's more news that hasn't come out yet, maybe because it's definitely up, which is great. Been a great year so far for the portfolio, which is a lovely thing. In the meantime, when we look at the term structure, we see that UVXY is back, and by that I mean it's back going down. The VIX below 16 now, VIX currently 1563, and the term structure looking very much normalized. Let's take a quick look at VIX Central here, and we can see that, contango, 3.42%. It's still less than maybe some people would like it, but, the chart looks very normal right now. Contango upwardly sloping, and there's getting to be some distance between spot and the first future. The so-called roll yield is starting to expand. So what have we got? It's like it's not up to a point yet, but around something like 70 cents, a little bit over 70 cents right now. The difference between spot and the M1 future. Remember now, when we're looking at VIX ETPs, we're concerned only with the first two futures, first 2 months, right now being February and March. Those are the two futures which UVXY is composed of. If we want to check out what UVXY is composed of, we can go to the ProShares website. So let's take a look at that real quick. And we can go down to daily holdings. Now you're going to notice that there is a short-term future swap here. Now, I would kind of disregard this because they use future swaps to save on margin requirements. I would just focus on this ratio between the two futures because that seems to remain accurate regardless of what other swaps they're using to help them save a little bit of money. So we see here the Feb future is there's 7,500, and the March future there's 16,000. So it's like 7 to 16 kind of ratio right now. So heavier on the second month, as every day some futures are sold in the front month and bought in the farther out month. That's what we talk about when we're talking about contango, because if we look back at our chart, okay, that front month future, some of those are being sold, and the back month, the second month, March future, some of those are being bought. So what that does is it allows there to be more room between the futures and spot, so that and as there's more room, that creates more space for the futures to fall towards spot, because remember, in a contango situation here, there's always the what the dynamic is these futures are all falling towards spot, right? So you've got the front month future doesn't have as far to fall towards spot as the second month. So as we move more of our holdings out to the second month, it just creates more space to fall, and that continues to allow UVXY to fall lower and lower. Because remember, over time, as time goes by, each day we're slowly falling towards spot. So we've seen UVXY. We haven't got back to the lows. We're getting closer to getting back to the lows. Let's just take a look at UVXY over time here, and that's the chart over the last few weeks. Pretty amazing. Actually, I'm sorry, that's a 5-day chart. Let's go to a year chart, though, and you're going to see the all-time low, 35 here. We're still a ways away from that all-time low, but we will get there. Now, in a, they talk about UVXY as an ETP that's always falling. Well, that hasn't really been the price action over the last few months. Look at this move up, big move up, and before resuming the fall. I mean, that really put a wrench. If you were just depending on this to fall for, say, your income or something, this really put a wrench in it, that spike back up above 90. But as we've talked about and as was predicted, the fall will resume and we will take out the low and move lower. It's just a matter of having patience and waiting for time to pass. This is what people are talking about when they're talking about shorting volatility in contango. It's not so much the VIX. Remember, the VIX oscillates back and forth, but VIX ETPs don't track the VIX very well, and because of contango and also because of forces like delta drift with leveraged ETPs, you get this downward move. If we look at TVIX, we're going to see more of a effect of having leverage. Let's see if I can straighten that out. It actually looks pretty similar right here, but over a longer term, you're going to see there is more of an effect for leverage here, and I would suspect that TVIX will take out the low before UVXY does, just due to the fact that there's more leverage in TVIX. All right, I wanted to go briefly to a question. Somebody was asking me to talk more about diagonal option diagonal spreads. Now, diagonal spread is basically just a spread where you're splitting not only different strikes, but you're also splitting different times till expiration. And you can do this for a variety of reasons. And it all really comes down to your opinion on where an underlying is going to move and how quickly it is going to move there or not move there. Really, you can be very precise with options trades. And one very important thing about actually trading a diagonal trade is to check out and see what sort of margin requirements it's going to have, because many times with diagonals, you're not going to get the sort of quote-unquote preferential margin treatment that you would get with a vertical. Now, in the same month. Now, with a vertical in the same month, of course, you have one option that you're long and one that you're short. So that the one that you're long kind of protects the one that you're short as far as margin's concerned, and therefore you generally don't have margin beyond what the price of the spread is. So let's just use a real example here just for interest. So let's say I want to sell in UVXY the April 50-55 vertical. Okay, so I'm going to sell one April 50 call. I'm going to buy one April 55. All right, and it looks like 177 would be a price, and it looks like that would cost $325 in buying power for one contract. Now we can go ahead and switch the month I'm going to go over here to custom, and then I'm going to switch the month. So we're going to sell on April. We're going to buy an April 50 call, and we're going to sell a March 55 call. Let's try that. And now you're seeing, because it's a diagonal and there's split months, this is going to take up a lot more buying power. Let me just make sure this is doing it right here. So now it's going to cost you $1,400 in buying power, and that is because this April contract, it's not giving you that preferential treatment that it would in the same month. So you want to be careful with diagonals. Diagonals can be great, but you want to check your buying power and see if it makes sense for your account to do such things. Now, one of the sort of trades with diagonals that we'd like to talk about a lot is sort of the poor man's covered call, it's called. And I can give an example with Apple for that. All right, so let's say that we're just bullish on Apple. Okay, Apple's 172 right now. So let's say we want to be long Apple. What we could do is we could buy a farther out call somewhere. Let's make it sort of a deeper call. So let's say we're buying the April 165 call. Okay, so this call we buy is going to sort of substitute for stock in a covered call. And then maybe we'll sell something a little bit closer against it, and we'll pick something that is out of the money, and we're thinking it might not get to that point, but we want to collect some income to defray the cost of our long call, A, and B, if it does go up to this point, yeah, so basically like that call substitutes for stock, the one we're long, we're going to cover the premium on that a little bit by selling some out of the money calls, and maybe we're able to sell several months out of the money calls against that and keep collecting income against that long position while maintaining a long delta. So let's say we sell a March 85 call against that. So the call we bought here, it acts like stock, and the March 85 call defrays the cost a little bit. Because remember, if we hadn't sold this call against it, this trade would be costing us an additional 85 cents. Okay, so this one, the buying power, is essentially the cost of the spread right now. And like I said, this 85 call could expire worthless. The stock could stay around here. We would collect that income, and then we could go on to sell another call against it once this call expires. And I like trades like this. It's kind of a crafty way to get long something that, A, with Apple, you don't want to spend $172 a share to get long it, because that's not a very efficient use of capital. You know, you spend $172 a share to get long it, and you know, you try to buy 10 shares, or you try to buy 100 shares, and it costs you, you know, $17,000, whereas you could just buy, once again, one of those, maybe like April 165 calls, and that's only going to cost you, well, $1,000. So much better to buy a call as a replacement for stock. It's a more efficient use of capital, but this call does have a premium that's slowly decaying, and to help defray that, you could sell a call against it in a closer month. So once again, this is called a poor man's covered call. You buy a farther out, sort of deeper call instead of buying the stock, and then you sell maybe a closer month out of the money call against it. That way, the trade goes your way, you make money if it goes up. If it goes down, you're at least collecting some premium from this call, and once the call expires, worthless, you can sell something else against it, but it's sort of protecting your downside and giving you income as you wait for it to be right and for the stock to rally in Apple. There's other examples of diagonals that can be used for other things. One thing a diagonal is definitely used for is to readjust a position that you already have on. So, for example, you have a trade on and one of the options is about to expire. So you might make a diagonal trade just to roll a short contract to a different month. They can be used to adjust positions a lot. But the key takeaway is that you want to make sure what sort of margin, what sort of capital and margin requirements are involved with a diagonal trade, because they can be more expensive margin-wise than trades that are either in the same month or calendars in the same strike. So that's that. Please give me any more other questions you have. I am working to put together some interviews. There's some great stuff in the hopper right now. And let me know who you want to see, and we'll try to get them on. There are some guys I would love to see, such as Warren Buffett, but I think their schedules are a little full right now to come on the show. But we try to get some good, interesting people to come on and talk to you. I'm going kind of heavy on the market makers front coming up, because I know people are interested in what it was like on the floor and what it's like now to be a market maker. So we're working to get some of those interviews moving forward. Please check out Gorilla Trades. They have great stock ideas. I'm not a great stock picker. Have more expertise at options and options theory, but Gorilla Trades are the experts at stock picking. And if you have subscribed to Gorilla Trades, and based on recommendation of this program, I would love to hear from you and love to hear your experience. So please feel free to reach out to me about that, and we can talk about it, either bring you on the show, or we can just talk about it in private, because I'd love to hear from people who actually have checked out Gorilla Trades service and had it work for them. I watched their picks and I checked them out, and they do great. It's amazing how many great picks Gorilla Trades has had recently. All right, well, thanks for watching today, and I will see you again soon. We're going to have a couple shows this week, and I'm going to be very active in the near term, so that's exciting. And I'll see you again soon.